Have you ever looked at a sprawling cityscape and wondered how real wealth is built? It's not about get-rich-quick schemes or lucky breaks. It's about something far more powerful, something accessible to everyone, investing. And today, we're going to unlock the single most important secret to building long-term wealth: the stock market. So, what exactly is a stock? Forget the complicated jargon you see on TV with frantic traders and flashing numbers. Think of it simply as buying a tiny piece of a company you believe in. When you buy a stock in, say, a coffee company, you become a part owner. When they sell more coffee and open new stores, the value of your piece can grow. It's that simple. You're not just trading tickers. You're investing in the growth of real businesses. But here's where the magic really happens. Many great companies share their profits with their owners. That's you, through something called dividends. Imagine getting a small, steady stream of cash just for holding your shares. Now, you could spend that money, but the truly wealthy do something different. They reinvest it. They use those dividends to buy even more shares. This creates a cycle of growth. More shares mean more potential dividends, which means you can buy even more shares. This powerful cycle is called compounding. Albert Einstein supposedly called it the eighth wonder of the world. Think of it like a small snowball at the top of a hill. As it rolls down, it picks up more snow, getting bigger and bigger, faster and faster. Your money works the same way. When you reinvest your earnings, you don't just earn a return on your initial investment. You start earning a return on your returns. It's earnings on top of earnings. Let's look at a simple example. Now you might be thinking, this sounds good, but isn't the stock market risky? What about crashes? That's a valid concern. But let's look at the evidence. The stock market has been around for over a century. If you look at a long-term chart of the S&P 500, which represents 500 of the largest US companies, you'll see a clear, undeniable trend. It goes up. Yes, there have been scary downturns. We've seen depressions, wars, and financial crises. Each time, the market dropped and fear was everywhere. But what happened after every single crash in history? The market recovered and eventually climbed to new highs. The logos of companies that have survived and thrived through these periods are a testament to this resilience. The key takeaway from history is this: time in the market beats timing the market. Trying to guess the perfect time to buy or sell is a losing game. The real winners are those who simply stay invested. This brings us to the biggest hurdle for most investors: psychology. Our brains are wired to react to fear. When the market drops, our instinct is to sell everything to stop the pain. We see red on the screen and panic. On the flip side, when everyone is euphoric and stocks are soaring, our fear of missing out kicks in and we might be tempted to buy at the very top. Successful investing is about mastering these emotions. It's about being patient when others are fearful and cautious when others are greedy. Imagine two investors during a market dip. One is glued to the screen, stressed, selling at a loss. The other turns off the news, trusts their long-term plan, and maybe even sees it as an opportunity to buy more at a discount. Years later, who do you think is in a better position? The patient investor, who understood that volatility is just the price of admission for long-term growth, is the one smiling. Let's make this real with a story. Meet Sarah. Fresh out of college at 25, she didn't have much money, but she learned about investing. She started putting just $200 a month into a simple, diversified stock market fund. Some of her friends thought it was boring. They were spending their money on the latest gadgets and vacations. In the beginning, Sarah's investment account grew slowly. There were years it went down and she felt nervous, but she remembered the lessons of history and compounding. She got a promotion and increased her contribution to $400 a month. Now, let's fast forward 40 years. Sarah is 65 and ready to retire. Her friends are worried about their finances. But Sarah? She checks her investment account. Thanks to her consistency and the magic of compounding, that small monthly investment has grown into over $1 million. Her journey wasn't about being a genius stock picker. It was about discipline and patience. Sarah's story shows that you don't need a huge income to build incredible wealth. You just need time and consistency. So let's recap the golden rules of building wealth through the stock market. First, invest early. The longer your money has to grow, the more powerful compounding becomes. Even a small amount invested in your 20s can be worth more than a larger amount invested in your 40s. Second, invest consistently. Automate your investments so that you're buying every month regardless of what the market is doing. This is called dollar cost averaging, and it helps you avoid the trap of emotional decision-making. And third, stay invested. Tune out the noise, ignore the short-term ups and downs, and trust the process. Let time do the heavy lifting for you. The journey to financial freedom isn't a sprint, it's a marathon. It begins not with a giant leap, but with a single, small step. By understanding that stocks represent ownership in real businesses, harnessing the unstoppable force of compounding, and mastering your own emotions, you can build a brighter, more secure future for yourself. The best time to plant a tree was 20 years ago. The second best time is today. Thank you so much for watching. If you found this video helpful and inspiring, please give it a thumbs up and consider subscribing for more content to help you on your financial journey. We'd love to have you as part of our community. Until next time, invest wisely and stay patient.